The mortgage interest tax deduction is the most talked about tax break in America. It is also the one most homeowners never actually get. Here is what is at stake. On a $400,000 mortgage at today's rates, you pay close to $27,000 in interest in your first year alone. That is real money out of your pocket, and the tax code says some of it can come off your income. So here is the answer, straight up. The mortgage interest deduction lets you subtract the interest you paid on your home loan from your taxable income, not from your tax bill, from your income. And you can only claim it if you itemize your deductions instead of taking the standard deduction. That last part is the whole ball game. About 9 out of 10 American filers take the standard deduction, which means about 9 out of 10 never touch this thing at all. But that is not the full story. Because even when you do qualify, this deduction is almost never worth what people think it is worth. There is a piece of arithmetic hiding inside it that turns a $27,000 deduction into roughly $800 of actual savings. I will walk you through that math. I will also show you the 2 changes that landed for 2026, which just moved a lot of households from the no column into the yes column. By the end, you will be able to check, in about a minute, whether any of this is worth a single dollar to you. Start with the word deduction, because it quietly does a lot of damage. A tax credit comes off your tax bill. A $1,000 credit means you owe $1,000 less. Simple. A deduction is not that. It comes off your income before your tax is even calculated. So a $1,000 deduction saves you $1,000 multiplied by your tax rate. If you sit in the 22% bracket, that is worth $220 to you. Not $1,000. Think of it this way. Nobody is paying your mortgage interest for you. The government is just agreeing not to tax the slice of your income that you spent on it. That distinction matters more than any other rule here. Every breathless headline about the huge tax break homeowners get is describing a deduction while quietly letting you picture a credit. That is the first trap. The second one is much bigger. Every filer gets a choice, and you only ever get one of the 2. Option 1 is the standard deduction. It is a flat amount the IRS hands you simply for existing. No receipts, no mortgage, no paperwork. For the 2026 tax year, that flat amount is $16,100 if you file single. It is $32,200 for a married couple filing jointly, and $24,150 for head of household. Option 2 is itemizing. You add up your specific deductible expenses, and mortgage interest is one of them. State and local taxes are another. Charitable giving is another. Then you take whichever number is bigger. That is it. That is the entire decision. Now look at what happened to that decision. Back in 2017, about 31% of American tax returns itemized. Then the standard deduction roughly doubled, and by 2022 that figure had collapsed to around 9%. 91% of filers now take the standard deduction. For every one of them, the mortgage interest deduction is worth exactly $0. That is not a loophole they are failing to find. It is just arithmetic. Their itemized total does not beat the flat number, so the flat number wins, which leaves an obvious question. If you are in the 9% who do itemize, what is this actually worth? Here is the part almost nobody explains, and it is the most useful minute you will spend on this. Take a real example. You bought with a $400,000 mortgage at about 6.75%. In your first year, you pay roughly $26,900 in interest. You are married, filing jointly. You also pay around $9,000 in state and property taxes. So your itemized total comes to about $35,900. Your standard deduction was $32,200. Itemizing wins. But by how much? $3,700. That gap is the only part that is genuinely new, because you already had the rest for free. At a 22% tax rate, $3,700 saves you about $814. So a $27,000 deduction produced roughly $800 of real money, not $6,000. $800, that is the trade. You handed back a free $32,000 deduction to claim a $36,000 one, and you pocket only the difference. It is also why financial planners wince when somebody says they are keeping a mortgage for the tax break. You are paying $1 of interest to save about 22 cents of tax. Nobody wins that trade. So who does this genuinely help? That depends on a ceiling most people never check. There is a limit on how much mortgage this applies to, and it hangs on one specific date. If you took out your loan after December 15th, 2017, you can deduct the interest on the first $750,000 of home acquisition debt. Married filing separately, that is $375,000 each. If you closed on or before December 15th, 2017, you are grandfathered under the older, more generous rule. That is $1 million, or $500,000 filing separately. You keep that grandfathered limit for as long as you keep that loan. Refinance carelessly and you can lose it. For years, the $750,000 cap was scheduled to expire and snap back up to $1 million. It will not. The 2025 tax law made the lower cap permanent. Here is what that means in practice. If your loan sits under $750,000, which covers the large majority of American mortgages, this ceiling is not your problem at all. If your loan is above it, you do not lose the deduction. You simply deduct the portion of your interest that corresponds to the first $750,000. That is the ceiling. Now, for the rule that trips people up far more often, which is what the borrowed money was allowed to be for. The loan has to be secured by the home. The house is the collateral. A personal loan you happen to spend on a new kitchen does not qualify. You can claim it on your main home and one second home. Not 3, 1. And the definition of a home here is wider than you would guess. The IRS accepts a boat or an RV as a residence as long as it has sleeping space, cooking facilities, and a toilet. People really do deduct interest on a boat loan this way. Now the trap. Home equity loans and lines of credit. There is a stubborn belief out there that home equity interest is automatically deductible. It has not been true since 2018. Interest on a home equity loan is deductible only if you use the money to buy, build, or substantially improve the home that secures the loan. Put it into a new roof or an addition, and it counts. Put it into credit card debt, a car, or a wedding, and it does not. Same loan, same house, same interest rate. The deduction depends entirely on where the money went, so hold on to the receipts from that renovation. Years later, they may be the only thing standing between you and a disallowed deduction. There is one more line item people get wrong, and it costs them at closing. When you close on a mortgage, you can pay points. 1 point is 1% of the loan, paid up front to buy your interest rate down. Points are prepaid interest, so they are deductible. But when you get to deduct them depends on the kind of loan. Buy your main home, and you can generally deduct the full amount of those points in the year you paid them. $4,000 of points can land on this year's return. Refinance instead, and the rule flips. Now you spread those points across the entire life of the loan. $4,000 on a 30-year refinance works out to about $133 a year. Same $4,000, completely different outcome. Your lender reports what you actually paid on Form 1098, which shows up in January. That form is where your real number lives. Do not estimate it. That is the old rule book. 2 things changed for 2026, and they matter more than anything else here. The first is mortgage insurance. If you put down less than 20%, you are almost certainly paying mortgage insurance. That premium used to be deductible, then Congress let it lapse, and for several years it was simply gone. From January 1st, 2026, it is back, and this time permanently. Mortgage insurance premiums are now treated as qualified residence interest, which drops them into the same bucket as your mortgage interest. There is an income limit on this one. It starts shrinking once your adjusted gross income passes $100,000, and it disappears entirely at $109,000. Halve both numbers if you file separately. The second change is far bigger, and it is not about mortgages at all. The cap on deducting your state and local taxes sat at $10,000 for years. For 2026, that cap is $40,400. Think about what that does to the wall we talked about earlier. Your state income tax and your property tax were being chopped off at $10,000. Now far more of them counts. For a couple in a high-tax state, that can add $15,000 or $20,000 to the itemized column overnight. And that is very often exactly what pushes a household over the standard deduction, which finally makes their mortgage interest worth something. The mortgage rule never moved. The deduction sitting next to it did. So run the check on yourself. It genuinely takes about a minute. Add up your mortgage interest from Form 1098, your state and local taxes up to the cap, and your charitable giving. Compare that total against $16,100 if you are single, or $32,200 if you are married filing jointly. If your number comes in smaller, you are done. Take the standard deduction and stop thinking about this. You are not missing anything, and no clever strategy fixes it. If your number comes in bigger, only the gap is worth anything, multiplied by your tax rate. The people this genuinely helps share a profile, a large and recent mortgage, because the early payments are almost entirely interest. A high tax state, because state and local taxes do the heavy lifting. And a higher bracket, because a deduction is worth more the more you earn. The people it does not help are just as specific: a small or nearly paid off mortgage, a state with no income tax, a modest bracket, and here is the part worth sitting with. If you are in that second group, nothing has gone wrong. It usually means your free standard deduction is already bigger than your actual expenses, and that is a good place to be standing. The tax code is not rewarding you for having a mortgage. It is just declining to tax the part of your income you already handed to a bank. So, the short version one more time. The mortgage interest deduction lowers your taxable income by the interest you paid on your home loan, but you only get it if your itemized total beats your standard deduction. And only the amount above that line is worth anything. Check your own number instead of assuming. That one comparison is the difference between chasing a tax break that does not exist for you and knowing exactly what your house is doing on your return. I want to know one thing down in the comments. Did the state and local tax change push you over into itemizing this year? Or are you still sitting comfortably under the line?